Welcome back to the deep dive. Today we have a stack of documents on the desk that, well, I'm not going to lie, it looks a little intimidating.
It really does. It looks like a complete cure for insomnia, honestly.
Yeah, exactly. We are looking at the new income tax bill,
Yeah.
specifically Section 58.
Right.
But, and this is a big but here, as we started going through the notes and the legal text, I realized this isn't just about taxes.
No, not at all.
It's about a trap. It's about a deal the government is offering small businesses, and I'm not sure everyone should actually be taking it. We're talking about the presumptive taxation scheme.
That's the perfect way to frame it. It is a deal. The government is essentially saying, hey, we know accounting is hard. We know you hate keeping receipts. So just pay us a flat rate and we'll leave you alone.
Which sounds great, right? I mean, who wants to keep receipts?
Nobody.
But our mission today is to really unpack the fine print of that deal, because Section 58 has some massive changes compared to the old rules. And if you aren't paying attention, you could walk right into a compliance nightmare.
Especially regarding how you declare your profit. There is a very specific phrase in this new text that completely changes the game.
Yeah, let's start right there, actually, because we usually save the big gotcha for the end of the deep dive, but this is just too important.
It really is the core of the whole thing.
The source material highlights this new rule, and it's called whichever is higher.
Yes. This is our immediate focus because it effectively kills what was a very, very popular tax planning strategy.
Okay, so to understand why this is such a big deal, we have to look at how things used to work. Walk us through the old days, the days of Section 44 AD.
Right. So previously, the law was a bit of a wink and a nod. The government said, if you are a small business, just declare 8% of your turnover as profit.
Okay,
So if you made 1 crore in sales, you tell the taxman you made 8 lakh in profit, you pay tax on that 8 lakh, and you go home.
simple enough. But what if I was a really, really good business owner? What if I actually made, say, 20 lakh in profit on that 1 crore? That's a 20% margin.
In the old days, you'd often still just declare the 8%.
Wait, was that legal?
It was accepted practice. The law gave you a floor. It said declare presumptive income. It didn't explicitly force you to look at your real books if you didn't want to.
Ah, I see.
So people used it as a ceiling. They would make these huge margins, but only pay tax on the statutory minimum. It was a perfectly legal way to suppress your taxable income.
I mean, that's a loophole the size of a truck.
Exactly. And Section 58 of the new bill drives the truck right through that loophole to close it up.
Oh,
The new text explicitly says you must declare the presumptive rate that's 6 or 8% or your actual profit, whichever is higher.
whichever is higher. That one phrase changes the entire dynamic.
Completely. Let's use the example from the source notes to visualize this. Imagine you're a consultant or running a small shop. Your turnover is 2 crore.
Okay, 2 crore turnover.
Under the presumptive scheme for digital payments, the deemed profit is 6%. So the government expects you to declare at least 12 lakh. That is the floor.
Right, 12 lakh.
But let's say this business actually crushed it this year. They had low expenses, really high efficiency. Their actual profit is 30 lakh. That's a 15% margin.
And in the old days, they'd just declare the 12 lakh and keep the difference quiet.
Exactly. But under Section 58, that is now illegal. Because 30 lakh is higher than 12 lakh, the law mandates that they declare the 30 lakh. The option to hide behind that lower presumptive rate is just gone.
So this whole simplification scheme is no longer a tax-saving scheme.
Precisely. It is strictly a compliance simplification now. You save money on accountants, maybe, but you do not save money on tax if your actual margins are high.
That is a massive shift. I really feel like a lot of people are going to miss that nuance and just blindly file the 6% like they always did.
And that would be tax evasion under this new section.
Yikes. Okay, so now that we've thoroughly scared everyone with the whichever is higher rule, let's back up a second. Let's look at the actual structure of this thing.
Good idea.
Because one thing the sources mention is that Section 58 isn't just a rule change, it is a structural consolidation.
It is. If you've ever tried to read the old Income Tax Act, it was a complete mess. You had Section 44 AD for shopkeepers, you had 44 ADA for doctors, you had 44 AE for truckers. It was scattered all over the place.
It's the total alphabet soup.
Exactly. Section 58 sweeps them all into one pile. It actually uses a table format right there in the legislation itself, which is quite rare.
Yeah.
It lists 3 distinct categories of taxpayers who can use this scheme.
I do appreciate when the law at least tries to be user-friendly. But before we break down those three categories, can we do a quick, explain it like I'm five on what presumptive taxation actually is? We've been tossing the term around a lot.
Sure. Think of it like a subscription service versus pay-per-view.
Okay, I like analogies. Go on.
The normal tax regime is pay-per-view. You have to track every single transaction, every cup of coffee you bought for the office, every electricity bill, every single rupee of revenue. You subtract the expenses from the income to find your exact profit. It requires detailed books, receipts, and usually a chartered accountant to make sense of it all.
Which is a huge headache for a small shop.
A massive headache. Presumptive taxation is the subscription model. The government says, look, we know you're small. We know you hate paperwork. So we will just presume, we will guess that your profit is a certain percentage of your sales.
So they just make an assumption.
Right. If you agree to that percentage, you don't have to keep any books.
So I don't need a balance sheet. I don't need a profit and loss statement.
No. You just need to know your turnover, your top-line revenue. The government applies a percentage, calls it your profit, and taxes you on that.
That does sound fantastic.
It is fantastic for reducing the compliance burden. But as we just saw with the whichever is higher rule, the government is making absolutely sure you don't use it to pay less tax than you actually should.
Right. The free ride is over. Okay, let's walk through this table in Section 58. Who actually gets to use this? Category 1 is general business.
Serial number 1, yes. This covers the vast majority of small businesses. Retail shops, traders, small manufacturers, the local bakery.
And who specifically is eligible?
It's available to an individual, a Hindu undivided family, or a partnership firm. But, and here's a very important exclusion, it does not include limited liability partnerships or LLPs.
Really? Why exclude LLPs? They're small businesses too, aren't they?
They are, but an LLP is a separate legal entity with its own distinct compliance structure. They are already required to maintain books and file annual returns with the registrar of companies.
I see.
So the government figures, if you're already doing all that paperwork for the registrar, you can show it to us too. You don't need the presumptive crutch.
That makes total sense. You're already doing the homework, so just hand it in. Okay.
Yeah.
What about size? How big can my business be to stay in this category?
The standard turnover limit is 2 crore. If your gross receipts are under that, you're in. However, there is an enhanced limit of 3 crore.
Oh, nice. How do I unlock the enhanced limit?
You have to be digital. To get the 3 crore limit, your cash receipts must be 5% or less of your total turnover. If you are dealing mostly in cash, you are firmly stuck at the 2 crore ceiling.
The government is really pushing for digital transactions, huh?
Aggressively. And it's not just the limit, it's the rate itself.
Right. Let's talk rates for these general businesses.
The deemed profit rates are bifurcated. If you receive payment via valid digital or banking modes, the government presumes your profit is 6% of that turnover. If you receive payment in cash, they presume your profit is 8%.
So going digital gets you a tax break, essentially. It implies a lower margin.
Yeah.
But when I was looking at the notes, I noticed a huge gotcha in Subsection 9 regarding what actually counts as cash.
Ah, yes. The check trap. This catches people out all the time.
Because intuitively, if a client hands me a check, I think, well, this is a banking transaction.
Right.
It goes straight through the bank.
You would think so. But under Subsection 9, the law is very, very specific. Only an account pay check or an account pay bank draft counts as digital.
Wait, so if a client gives me a bearer check, or just a standard check where they forgot to cross it and write account payee,
then the law treats that piece of paper exactly the same as a suitcase full of hard cash. You have to declare 8% profit on that amount, not 6%.
That is wild. So literally a slip of the pen just forgetting to write account payee only increases my taxable income.
Yes, it does. The logic is that bearer checks are too easily endorsed to someone else and used just like currency. The government wants a clear, traceable digital trail.
Wow.
So if you're a business owner using this scheme, you need to be militant about checking every single check you receive.
That is a really good tip. Stamp account payee on absolutely everything. Okay, moving on to Category 2 in our table, goods carriage, the truckers.
Right. This is for those in the business of plying, hiring, or leasing goods carriages. The first barrier to entry here is the fleet size. You cannot own more than 10 vehicles at any time during the year.
At any time. So if I have 10 trucks and business is good, so I buy an 11th one in, say, November.
You are kicked out of the scheme for the entire year. You have to go back and do full bookkeeping for the whole period from April through March.
Brutal. Okay, assuming I stay at 5 trucks, how do we calculate the income? It's not a percentage of turnover here, is it?
No, because turnover in the trucking business is messy. Cash changes hands constantly. Trick lengths vary, so they just tax the asset itself.
Break that math down for us.
If you have a heavy goods vehicle, meaning the gross vehicle weight is over 12,000 kilograms, the deemed income is 1,000 rupees per ton of weight per vehicle per month.
Got it. And for smaller trucks, like delivery vans?
For anything else, it's a flat 7,500 rupees per vehicle per month.
I saw a note in the source about part of a month. How does that work?
Yeah, that's another strict rule. If you buy a truck on the 28th of the month, you pay the deemed tax for the full month. There is no pro rata calculation.
Sure.
Ownership for any part of a month counts as a full month.
That seems pretty rigid. But there is a silver lining for truckers, specifically regarding partnerships, right? The partnership exception.
Yes, this is fascinating because it's a deviation from the other categories. Subsection 5 says that if a partnership firm is in the goods carriage business, they can deduct partner's salary and interest from that deemed income.
Wait, so the general businesses, the shopkeepers we just talked about, they can't do that?
No. For the shopkeeper, the deemed profit, that 6 or 8%, is final. You cannot deduct partner's salary from it. But for truckers, you can. It's a unique benefit just for the transport sector.
Interesting. Truckers get a special lane. Okay, let's hit category 3. Specified professions.
This covers your doctors, lawyers, engineers, architects, basically the knowledge workers,
Eligibility.
resident individuals or partnership firms, and again, no LLPs.
And what are the money limits here?
The limit is lower than for general businesses. Gross receipts must be under 50 lakh. There is an enhanced limit of 75 lakh, again, provided that cash receipts are 5% or less.
And the rate, because this is the one that made my eyes water when I read it.
It's a flat 50%. The government assumes that for a service professional, half of what you earn is pure profit.
50%. That feels incredibly steep. I mean, a professional might say, I have office rent, I have staff, I have expensive software subscriptions.
True, but the government's counter-argument is you don't have inventory, you aren't buying raw materials, your main asset is your brain. So they assume your margins are much, much higher than a guy selling shoes.
Fair point. So if a doctor earns 60 lakh in receipts, mostly digital, they just declare 30 lakh as taxable income. Pretty simple.
It sounds simple, and usually when things sound this simple in tax law, there's a sting in the tail. And I think we found it in Section 58, Subsection 4.
We absolutely did. And this is where the deep dive gets serious. This is the part that might make some listeners rethink using the scheme entirely.
The section deals with deductions, or rather, the total lack of them.
Right. Section 58, Subsection 4 imposes a blanket prohibition. It says any loss, allowance, or deduction shall not be allowed.
Any. That is a very absolute word in legal terms.
Let's talk about the side hustle paradox here. Because a lot of people might have a job in a small business, or they might have investments on the side.
Exactly. The most common scenario here is the home loan. Say you have a presumptive business income of 10 lakh, but you also own a house and you pay interest on the mortgage, which generates a loss of 2 lakh under income from house property.
Now, in the normal tax world, I would just subtract that loss. 10 lakh income minus 2 lakh loss equals 8 lakh taxable income.
Correct. But under Section 58, the text suggests a hard no. It says, no loss shall be allowed to be set off.
So I pay tax on the full 10 lakh.
That's exactly how it reads. You completely lose the benefit of your home loan interest deduction against your business income. That effective tax rate just jumped way up.
And it's not just home loans, is it? What about standard deductions like ADC, life insurance, provident fund?
It's ambiguous, but highly risky. The section says, any deduction allowable under the provisions of this Act. Technically, Chapter 6A deductions, like ADC, are under this Act. Unless there is a saving clause hidden elsewhere, a strict reading says you cannot claim them against this presumptive income.
Wow. So you get the simplicity, no books, no audit, but you lose the ability to lower your tax bill through all these standard mechanisms.
It's a trade-off. Convenience comes at a cost. You are essentially paying a premium for the luxury of not doing bookkeeping.
Which brings us to the part of the show where we look at the logic of the law itself. Because when we were reading through the source material, you pointed out a bit of a paradox, a catch-22.
Yes, this is the philosophical puzzle of Section 58. I like to call it Schrodinger's profit.
Okay, lay it out for us.
Let's look at the two main pillars we've discussed today. Pillar 1. If you use this scheme, you do not need to maintain books of account.
Right, that's the carrot they dangle.
Pillar 2. You must declare your actual profit if it is higher than the presumptive rate.
I see exactly where you're going with this.
The fundamental question is, how does a taxpayer know their actual profit is higher if they aren't keeping books in the first place?
Oh, wow. Yeah. To know that my profit is 15% and not 6%, I need to have calculated my profit. But the law explicitly told me I didn't need to calculate my profit.
Exactly. It creates this incredibly weird situation where you are complying with the law by not keeping books, but you are potentially breaking the law if your unknown profit happens to be higher than the flat rate.
It's a trap. Because if the tax department comes knocking 3 years later,
And they ask you, how did you determine that your actual profit wasn't higher than 8%? And your answer is, well, I didn't check because Section 58 said I didn't need books.
will that answer hold up in an inquiry?
It is a very risky position to be in. It effectively shifts the burden of proof onto you to prove a negative without the documentation to back it up. Is the relief from bookkeeping actually a trap that leaves you totally defenseless in an audit?
That is a chilling thought. So what is the practical advice here? Even if I use the scheme, should I just keep a shoebox of receipts?
Absolutely. Keep a shadow set of books. You don't need to get them formally audited. You don't need to file them, but you need to have them on hand. If an officer asks, are you sure your profit wasn't 20%? You need to be able to pull out a spreadsheet and say, yes, look, here are my expenses. My margin was only 7%.
So much for no paperwork.
Reduced paperwork, let's call it.
Now let's look at the flip side of that paradox. What if I do the math, I keep my shadow books, and I realize, hey, actually I had a terrible year. My margin wasn't 6%, it was only 2%. Can I opt out? Can I just pay tax on the 2%?
You can, but you enter what I call the penalty box.
The penalty box.
If you claim your profit is lower than the presumptive rate, you lose the privilege of the presumption. First, you have to formally maintain books and get them audited by a chartered accountant, regardless of your turnover size, as long as your income exceeds the basic exemption limit.
So a mandatory audit. That's expensive.
Very, but here is the real kicker found in subsection 7. If a general business category 1 opts out and declares lower income, they are barred from returning to the presumptive scheme for the next 5 years.
5 years.
5 straight years, you are locked out. You have to maintain books and get audited for half a decade.
Just because I had one bad year and wanted to pay tax on my actual lower income.
Correct. The government wants you to pick a lane and stay in it. They don't want you flipping in and out, using the presumptive scheme when your profits are high to save tax, and then using actual books when your profits are low to save tax.
So if I opt out even once, I'm committing to 5 years of accountants and audit fees. That is a massive financial decision for a small business.
It really is. And interestingly, this 5-year ban specifically mentions the general business category in the text. It doesn't explicitly apply to the professionals or the truckers in the exact same way based on the documents we have. But for the general trader, it is a strict lockout.
Wow. So let's try to summarize this deep dive. Section 58 is a consolidation. It makes things look cleaner. It gives you a nice, neat table.
Yes, it simplifies the user interface of the tax law, so to speak.
But that whichever is higher rule means you can no longer legally hide super profits behind a flat rate. And the no deduction rule means you can't use your business income to absorb losses from your house or your other investments.
That's the perfect summary. Simple does not necessarily mean cheaper. For many high-margin service providers or really efficient businesses, the regular tax regime where you keep books and claim all your legitimate expenses might actually result in a lower tax liability than this simplified 50% or 8% rate.
That is a crucial takeaway for you listening. Don't just assume the presumptive scheme saves you money. It saves you time, but it might actually cost you tax.
Precisely. You are paying a premium for that luxury of not doing the bookkeeping.
And here's where I want to leave the listeners, with that final provocative thought we discussed.
It goes right back to that paradox.
If the tax department audits you, and you haven't kept books because the law explicitly said you didn't have to, how do you prove your actual profit wasn't higher than the deemed rate?
It forces you to rely entirely on faith, and faith is a terrible strategy in tax court.
A terrifying thought to end on. If you're using Section 58, keep that shoebox of receipts anyway, just in case.
Always good advice.
That's it for this deep dive into Section 58. Check your actual versus your deemed reality. Watch out for those bearer checks, and we'll catch you on the next one.
Stay informed.